Hi there, my name is Daniel Welsh, and this is a presentation which is for a strategy course here at Queen's Commerce, COM 402. And the topic that I'll be conducting this presentation on is student housing versus residential housing real estate investment during economic shock. And so, what I'll be looking at is how did firms react to the housing bubble of 2008, what stressors were put on their organizations, etc. And so I'll explain a little bit more about that now. So, research questions. My primary questions that I'm here to ask is by means of inductive analysis, what was the observed impact on student residential real estate in comparison to regular apartment housing during the 2008 2009 real estate and equities market collapse? Secondly, was bankruptcy stress observed during the collapse? If significant, could this stress be easily hedged through asset allocation, cash reserves, or other different hedging strategies? And so, my motivation for studying these topics is I'm interested in pursuing a career in real estate, in the different functions of real estate from the perspective of a long-term income holder of real estate, from a developing perspective of somebody who's doing greenfield development from scratch, all from the private sphere. And so what the purpose of this analysis is to really get to answering questions about what happened during 2008, 2009. I'm using public equity proxies of real estate to conduct an analysis because I can get some reasonable information on that. Now, of course, public world versus private world are very different, and a whole bunch of the analysis that's going to be conducted following will get into some of those differences. So here's some specific rationale for conducting the research that I want to do. So firstly, real estate is an industry where rate of failure is quite high. Even in strong market conditions, developers frequently go bankrupt because of cash flow problems, market mistiming, project delays, and poor product market analysis. And this really gets to the nature of real estate and some of the problems that are faced in it. Real estate is, can be thought of as a capitally constrained business, and what that means is that profits, income, are really a function of capital deployed. And because that function's quite set, a talented real estate professional, let's say it's somebody who's, buying existing assets and owning them from a long-term income-based perspective. As an advanced or competitive corporation in that space, you can be working for, margin percentages, better than market price here and there, but they're really percentages. It's not like, traditionally isn't like, let's say, technology, where all of a sudden, one breakthrough technology can give us massive amounts of market share and massive return on investment. The ROI calculations are much tighter, and so the spread of getting something that's favorable is we're talking percentage points, not multiplicities of differences in return on investment between companies. Why this matters is that during contractionary events and stressing events, what you can have is asset prices collapse. You can have liquidity freezes within financing markets, and these events, because your business is capitally constrained, you will you could face insolvency because you just don't have the cash requirements to meet your long run obligations that are absolutely necessary. And without meeting those capital obligations, your business will simply go insolvent. I'll go through some examples to really kind of hit that home later on and throughout the presentation, but that's just a good starting point. The next idea is the business is capitally constrained, meaning that output is largely a function of capital deployed. Therefore, bankruptcy is coupled with large capital losses, unlike other entrepreneurial suits where labor factors are a greater percentage of cost. Therefore, a single disastrous project / macroeconomic event can erase decades worth of returns. And that's exactly to what I was just talking about. To try to bring this home, what I have here is that, capital does make a larger percentage of importance of your efforts in real estate in comparison to labor in, let's say, a technology space. And because of that, because the optimization function and the return function is calculated quite a bit better, it becomes hard to erase and recover from disastrous economic shocks or asset price collapses, because there's no way that you can innovate your way through it, etc. So for example, Google, let's say Amazon, because they kind of deal in both spheres and both worlds. So if Amazon was to go through 2008 right now, and they had their share price slashed in 50%, their share price would be slashed by 50% because of overall market sentiment about the economy, consumer spending power, etc., which will likely recover in the years coming. Whereas if you have a 50% drop in share price in a real estate investment trust, that is because, rationally, consumers believe that the underlying assets of that portfolio have really depreciated by 50%, right? Because it is a proxy for buying that physical, tangible asset. The consumer who's buying into the REIT is not buying, a whole pile of different technologies that could be potentially working on, new building technologies for real estate. They're buying physical assets themselves, and therefore the relationship between that stock price and the underlying assets is much more firm than in a non-asset constrained business such as Amazon, who's adding value by developing new technologies, and the consumers are paying for the returns and the idea that those technologies will produce economic output in the future. So my goal is to educate about the degree of risks. What are the macroeconomic indicators I can be looking for, and how can these risks be insulated against to avoid disastrous outcomes? And really, disastrous outcomes, in my perspective, as a private real estate professional, would be really bankruptcy, insolvency. That's where you see real great 10-year loss, is when you get into difficult financial situations, have to sell assets at a loss to cover positions in other assets, and that's where you get you destroy long runs of work and deplete your capital base. So really, from my perspective, my disastrous outcomes lens is really insolvency, and I'm looking to say, how do we make sure we stay out of an insolvent position, or a position where we need to sell off assets when they are priced at a low, because the market's going through a cycle, and how do we weather that storm and still come out on the other side? Because it's selling at that low that really will crush your long run returns, and as well your capital base to be playing with in the market. So, overview of methodology. So, I conducted an analysis through real estate investment trusts, or REITs, as a proxy for holding real estate of a certain product type. And so, a real estate investment trust is simply a publicly traded entity, which is usually takes the form of being a property management company and an investment management company. So, for example, we'll get into the descriptions of the REITs that I analyzed, but their focus is on real estate. They're real estate trusts. They're publicly traded, which means that they have the bonus of added liquidity because the shares can be freely traded while the underlying assets are much less liquid. In the past, it's been a great instrument for collecting, vast public dollars to buy and diversify one's real estate portfolio, which is, a problem that faces many people in the industry because they can't. Because they can't get that diversification because they don't have they're not a high net worth individual or something. Or, even in real estate, true diversification is even difficult for high net worth individuals because if we're talking about diversification of product segments, markets, etc., you could be in for, 20 to 100 to $500 million a building, right? So even for very wealthy people, a $500 million single investment is obviously massive. So REITs have been a good way to pool money and give retail investors and institutional investors broader exposure. So the analysis is conducted from the perspective of a long-term investor who will not pull money out of the market during the collapse. Like I said, from my perspective, why I'm conducting this analysis is I want to know what I have to do to hedge downside, to hedge myself from getting into a situation where I would be forced to sell assets at a market low because I was required to do that for insolvency problems, for debt renegotiation problems that can't go through, etc. Because I'm taking a long-term perspective of somebody who's going to be having a lifetime career in this space, and I'm confident that the markets will recover. I'm holding assets for their income producing ability and somewhat for their capital producing or capital appreciation, but a majority of my returns as an income holding investor come from the income itself, and then I think of the capital appreciation as an added bonus. That is kind of like, I think that's important because I'm going to be framing my entire analysis from that perspective. So next, retail housing overview. So this is kind of some background information for people who might be less aware, etc. So retail housing overview. So selected it because it's my interest to pursue a career in. I've scoped this to residential housing, and that's actually I've scoped it to residential housing because, as we'll talk about risk in real estate, it's a less risky segment. Plus, I'm more interested in from an architecture and design perspective, and so therefore this was a good place to start. The other thing to mention is that the whole reason of doing student housing versus regular residential apartments is because I'm actually right now a property manager and operate an investment company who plays in student housing markets, and I've had a lot of intuitive guesses to the benefits of playing in those markets, etc. And so this exercise is also about me going through and actually confirming and testing a whole pile of the hypothesis that I've had in the past. So residential real estate is generally considered to be the lowest risk product type within real estate assets. In real estate, vacancy equals your risk. And if you look at this lower bullet point, so a 10% increase in vacancy is equivalent to toothpaste decreasing in price by 10%, but the cost base is fixed forever at the original purchase price. And so that's kind of trying to demonstrate what vacancy does. So you have a building. When you price that building, it's based on sometimes a small vacancy allowance, let's say 2 to 4% vacancy allowance. So the income already deducts vacancy as an expected expense, because in regular market turnover we'll always have it's part of the switching cost and the leasing cost of getting somebody new into the unit. But why vacancy is so disastrous and the core risk driver of real estate is because effectively at the end of the day you pay for that entire asset. You pay for the $10 million building based on the valuation of, like, let's say 1%, 2% vacancy or something like that. So let's say vacancy spikes now to 10%. All of a sudden, you have an asset where the rate of return is based on it being 98% full, or you realizing 98% of the potential top line income on it, but you're only getting, let's say 90% of the top line income. And so when vacancy spikes like that, when you're at full occupancy, when you're at full utilization rates, just like any capital asset, you will likely be making decent money. Things turn sour very quickly and can go cash flow negative when your vacancy spikes like that, because your top line dollars just aren't there any longer, and usually you have all of your operating costs at the same rate. So your cost base stays the same, and you just have your top line revenue shrink and shrink and shrink until the building becomes cash flow negative and is going to start needing injection from exterior sources, etc. And so vacancy risk is the least possible in residential real estate, because when you go through an economic recession, what happens? Businesses go out of business. So commercial real estate, business goes out of business. They default on their commercial lease. All of a sudden, that space is now up and available. When it comes to the residential side, usually people need a place to sleep at night, and therefore the last thing that people will do is lose their home, right? Because after they've lost their home, they could potentially be homeless. They could potentially be moving in with somebody else, a family member, etc. And so even in economic recessions, vacancy rates don't really spike crazy amounts in residential real estate, because people need a place to put their head at the end of the night. Whereas, commercial ventures, businesses go bankrupt, businesses die, and when they die, they no longer need the office space that they used to have. So therefore, we'd see quite a large return premium on commercial real estate, because vacancy risk is so much higher, and therefore we need to compensate for that. One of the things that I'm interested in, and this is why this is scoped to residential real estate, because vacancy risk's lower, and therefore this is a great place to start off of, in the lowest asset class of real estate. Let's get a sense for the true risks and the true risk exposure that would happen during a recession. And the recession that we're going to be looking through this is actually a great it was the Great Recession, but it's a good recession to analyze this through, because it was fundamentally a real estate related collapse, which in modern history we don't have too much great evidence on. So what this means is that this is a good worst case scenario type testing, because the recession itself was fundamentally linked to real estate prices. So this gives us a good idea of not just if there's a recession, but if there's a real estate related recession, what kind of stressors could we be potentially seeing? So the REITs that I've chosen to analyze is the first one is Essex Property Trust, and they invest in residential apartments on the west coast of the United States. They own 60,239 units, and they're in a lot of very popular markets on the west coast of the United States. This is a residential apartments, not student housing, but residential apartments. The next one is EQR, and this is Equity Residential. They invest in residential apartments in Boston, New York, Washington, D.C., San Francisco, and Southern California. Assets are diversified in quality. They're in low-income housing, they're in higher-income housing, etc. They own 78,000 units. So these two first guys here, those are the residential apartments REITs that we'll be looking at and using as a proxy to get an understanding of what happened to the residential housing market during 2008. The second two is Education Realty Trust, EDR. They specialize in university student housing. They own 64 communities with 12,294 apartments and 32,000 beds. Assets are held on 38 university housing campuses across the United States, so they're highly diversified from a geographical markets perspective. And American Campus Communities, ACC, which specializes in on-campus and off-campus student housing. They own and manage 206 properties with 132,000 beds. Assets are also widely held across the United States. So this top one here is are the two REITs that we're looking at for residential apartments, and the student housing REITs are these two bottom ones. And in later slides, I've done a good job of color coding, and we'll be always talking from the perspective of residential housing versus student housing. So here's our first graph, I guess. So here we can see information about what happened to the stock prices of these REITs during the crisis. This alone does not tell us much information because the information is not normalized, and therefore it cannot be fairly analyzed. The purpose of this slide is to demonstrate that these funds did significantly experience a shock during the years of the Great Recession. So, for example, and this pattern will occur across all slides. So in the yellowish tinge colors is ESS and EQR, and that is ESS is Essex Property Trust, EQR is Equity Residential REIT, and then the blue will always be the education or student housing real estate investment trusts, which is Education Realty Trust and American Campus Communities, and those are in blue there. And so because of just the share prices are arbitrary, right? Because it matters how many shares are issued, etc. So this makes it look that ESS suffered a greater decline, but that's not necessarily true. The only purpose of this is to show that yes, these REITs were significantly impacted from late 2008 into 2009. So here I've now normalized the returns and added the S&P 500 as a baseline indicator to kind of guide this conversation. So since the various REITs did not start at the same time, returns have been zeroed from the date that the last of the studied REITs was originated. So essentially, in 2005 was, out of the four REITs that I looked at, the last one was created in 2005. This has to be the starting point, because otherwise the other ones that have been around for longer, if I zeroed them based on their starting dates, then the returns would be skewed as they'd have a longer compounding effect. And so what we're able to, generally and quickly see here is that all of the REITs significantly dipped. They're stacked on top of come on. Oh, come on. They're stacked on top of each other right here during the crash, but we'll look into it more. But the big thing that we want to look at is, I guess from 2005 as a starting point for percent returns, all of these funds saw dramatic, shock, I guess, during the crisis, and so we'll continue to get a little bit more into that. And so this slide is going to talk to you more about real estate investing in general and investment strategies in general, which will help give context for the whole reason why I want to conduct this analysis. So in this graph, the student housing REITs, which can be seen down here in blue, look relatively weak. But that's because, as you can see, their starting origination dates are only in 2004 and 2005, which mean that they're missing out on compounding effects. I just left them in there because they're relevant to the entire analysis that's going on. But instead, we're going to shift our focus to the residential housing real estate investment trusts of ESS and EQR, and in comparison to the S&P 500. And the whole purpose of this slide is to really show the importance that hedging and protecting your capital base does to long-run returns, and really gives the rationale to why I'm so risk adverse and want to make sure that I never have to take an action where, because of cash flow requirements, I need to liquidate assets at very low prices in order to meet my current right now and then cash requirements. And that's illustrated in this graph perfectly. So for example, these returns are adjusted returns, which means that they account for capital appreciation and as well as dividend payouts, stock splits, etc. So these are actually very good indications as to total returns of dollars invested in each one of these vehicles. All return lines are zeroed in early 1993, which was when these residential REITs started, and to go from 1993 to today. So 1 second. So one of the first things to look at is from 1993 to present day, capital has appreciated by 500% in the S&P 500. And the S&P 500 is this green line that kind of skirts along the bottom here. And this is the point now that I'm looking at, I guess, today. And I'll actually just erase these so I can continue to draw. There we go. So right here. Oh, come on. So as we can see, from this point at this side of the graph to this point at this side of the graph, we're at this 500% return line. So meanwhile, the two apartment REITs have appreciated by roughly 3,500% for ESS and 1,500% for EQR respectively. So, this is a great divergence in returns, right? We're talking about a 5 times difference in returns in this equity ESS real estate investment trust in comparison to the general broad market, and as used as visualized through the S&P 500 as a proxy for the market. So, and the interesting thing where being downside and risk adverse really comes through and really rationalizes and concrete and solidifies why this analysis is so important and hedging against this downside risk is so important, can be explained by a single event. And that single event is the tech bubble that went from 2000 to 2003 here. So these dates right here. And this is really where the divergence happens. So notice what happens during the tech bubble. The S&P 500 declines by 50% from 2000 to 2003, right? So from the normalized zeroing point of 1993, we reach a peak here at the peak of the tech bubble, where general market returns are about 250%, and they decline by around 50% to its very bottom in 2003. So therefore, when the market now appreciates, right, because every time if you destroy your capital base by 50%, you need a 100% return to get back to your original starting point before that market collapse. And that's the fundamental idea behind compounding interest, compounding capital, and capitalism is that it takes money to make money, and destroying your capital base really destroys long run returns significantly. So the S&P decreased by 50% during this tech bubble, but look at what happens to ESS and EQR. It's not that they necessarily performed skyrocketing fantastic through this time period, but really they just weren't affected. They continued to appreciate at a very reasonable rate, which means that on our next bull run from 2003 to the next decline in late 2008, which is seen through this region, the S&P 500 appreciated by 81%. So that means from this point right here to this point, right here at the next peak for the S&P 500, that's 81% returns, which is actually not horrible. But once again, here is the compounding nature of capital of real estate. So in the same period, from 2000 to from 2000 to 2008, before the collapse, ESS, this guy here in the highest line on the chart, appreciated by 181%. So that is stronger performance than the S&P 500, but actually during this period, it's very similar. It's about 100% appreciation during this period from the end of the tech bubble, so right here, all the way to right here. So we move from about 500% returns since 1993 into the range of about 1,200% returns. So it's a little bit over 100% returns. So actually real estate performed slightly better during this period, but not significantly better during the bull run of 2004 to 2008. But because real estate did not face a collapse during the tech bubble, and continued on a reasonable rate of return during this period, we really see the compounding effects starting to take off, and why at the end of the bubble in 2008, if you invested $1 in 1993, it would have appreciated to $2.50, very similar to what the peak was at the end of the dot-com bubble. In contrast, ESS, if you had invested it in this real estate investment trust, your $1 in 1993 would have appreciated to about $12.50 by the time that markets were going to collapse. And this can solely, during this period, during this bull run, both equities as represented with the S&P 500 and real estate had very similar performance. Yes, real estate performed slightly better, but it was slightly better. But this great divergence is all because real estate did not have its capital base destroyed from 2000 to 2003. So by hedging against this one horrible, bear market, this is the difference in compounding returns. So this begs the question, right? This is why being risk adverse and making sure that you do not have to take losses and sell assets and can ride out a bull run or a bear market in real estate is so important, because what will happen is you maintain your income producing ability, which accounts for a majority of your returns, and you do not have to sell assets when assets are at its cheapest. You can ride it out, and you can potentially sell those assets back when they recover to normalized prices in 4 years' time after that 50% decline event, which is what happened in 2008. So then, the next thing to notice then, because this is, now we want to look at the really great divergence, which is, up to present date, where now $1 invested in ESS is now worth $35, and $1 invested in the S&P 500 is only worth $5. So how do you explain that? And so actually, and this further illustrates this point, is from the end of the crash, so the very bottom right here, from the very bottom to modern day, the S&P 500 has appreciated by 1,000% or 10 times. Meanwhile, ESS has appreciated by 500%. So it's had half as good performance over the last almost 10 years now, since the bubble and since the crash. So half the performance, but look at this, right? So with ESS, we went from 500% to 3,500%. 500% times, or 3,500% divided by 500% is 5 times performance. Conversely, the S&P 500 went from about 50% of 1993 value to 500% of 1993 value over the same period, a performance of 10 times. So, but once again, this shows because real estate avoided this and was uncorrelated to market risk during the tech bubble and didn't have its asset base destroyed, this 5 times performance still means we're 35 times up on our $1993 today versus only 5 times up on our $1993. And this is truly the fundamental point which this whole kind of like research thesis is built around, is let's get a good and proper understanding of what our actual market risks are in this situation in real estate, and make sure that we can take all the steps possible to avoid a capital base destroying event, right? Because in real estate, in privately held real estate, you only destroy your capital base is when you sell. When you're selling property, for below what you paid for it, right? So even if we can stay at ground zero, which is selling at what we purchased it at, adjusted for inflation, let's say, even if we can stay at that, that is so much better for long run returns than having to be forced into a situation where you have to sell distressed assets to cover other distressed assets. And so, I'll move on now, but this is really the fundamental point and idea of why this is important. So the next thing that I looked at was market betas before 2006. And quick refresher on what market betas are is, market betas is the relationship of volatility of how stock price, equity price volatility correlates with general market movements. So, for example, with a beta of 1, let's say ESS had a beta of 1. If ESS had a beta of 1, every time that the general market moved up by 1%, ESS would move up by 1%. Every time it moved down by 1%, ESS would move down by 1%. Now, a beta of 1.2 would be a 1.2 multiplier. So if ESS moved up by 1, or if the S&P 500 moved up by 1%, ESS would move up by 1.2%. Likewise, if it moved down by 1%, ESS would move down by 1.2%. So it is a multiplicity more volatile than the general market itself. And so the whole purpose of conducting beta analysis is to get a sense of how related real estate has been to general market returns. And of course, real estate as measured by the proxy of these publicly traded real estate investment trusts. So throughout this period, we find that residential real estate proves to be a very good unrelated hedge against S&P volatility. This is important as it means that real estate is a good way to protect capital during equity collapses, at least through the eyes of the dot-com bubble. Although the betas below are positive, this is really an externality of the natural progression of markets and not necessarily a connection to equity returns. Things appreciate in value over time in an inflationary economy. The extremely poor are squared values, right here and right here, show that these beta coefficients almost carry no significance. So meaning that that we couldn't find any statistical relationship from 1993 to 2006, we really couldn't find any statistical relationship between residential real estate and the S&P 500. Therefore, an unrelated asset class is fantastic for overall portfolio hedging. So therefore, when considering avoiding bankruptcy risk in one's real estate portfolio, having a secondary of assets invested in other assets than real estate would be a good strategy to insulate and cover interest / debt payments during a real estate collapse. So for example, having a diversified portfolio within your real estate company itself, where you keep cash reserves in other asset classes, through the eye of 2001, right? Because this is going to change. But through the lens of 2001, having that secondary diversified portfolio would have been great, because the two asset classes were highly unrelated. But of course, this is all going to change. And interestingly, these findings that I'm stumbling upon right now of looking at these asset classes through the lens of 1993 to 2006 is exactly the information that Wall Street and bankers used to guide investment practices that caused the 2008 market crash. The historically unrelated nature of equities and real estate made it, popular thought that they were good instruments to insulate against short-term margin requirements in either of these two asset classes, right? So if real estate tanked, we could use our equity portfolio to cover it, and if equities crashed, we could use our real estate portfolio. And this shows when data lets us down, because these two, real estate and general equities, had co-moved together before, in history. But really the thing that fundamentally changed was there hadn't been one in recent history, and so we didn't have the ability to model that it was possible for these two asset classes to co-move in the same direction. So as we know now, this view was too narrow, didn't consider the potential relationships between real estate and equities, and therefore now we should try to consider developing even more complex and more thoughtful and more risk-adverse hedging strategies if these two markets co-moved in a downward direction again. So here now we'll look at the regressions, and these are really to show the how weak, I guess, the predicted returns would be. So this is the S&P 500 predicted returns of ESS, which is the residential REIT, once again, from 1994 to 2006. And so in blue, we can see all of these points scattered throughout here. This is what ESS's return actually was, and based on our best linear regression against market returns, this is in yellow the predicted slope of what should have happened. And so as we can see, the residuals between the two is just fantastically great, and there's absolutely no relationship to the two, and therefore this is also seen and demonstrated in this R-square value, which shows that the statistical significance of these two asset classes being correlated by some coefficient is very little from the time period of 1994 to 2006. Likewise, here's EQR, which is our other real estate investment trust that we analyzed, and once again the exact same things found. There's an R-square value of 0.086, meaning almost no statistical significance, and once again that can be visually verified here by looking at all of these EQR predicted or the EQR actual return points versus what would be predicted by our linear regression if it was correlated to market performance with any significance. And so, the broad conclusion is that from 1994 to 2006, there's almost no relationship between returns of real estate markets and general equity markets themselves. So the next thing that we're going to move on to is market betas during and post the 2008 crisis. So immediately when you look at this information, the relationship of the S&P 500 and real estate returns from 2004 to 2018 become apparent. The second set of numbers, titled Midnight, shows the relationship in a concentrated time frame leading up to the market collapse. So this is during the bubbling phase of the market, which I've called midnight because it's before clock strikes 12 and things come tumbling down. So during this time period, ESS, which so now with color coding again, in the orange tinge colors we have the residential, and in the blue tinge colors, we have the student housing numbers. And so ESS shows a beta of 1.237, showing exuberant strength of the market in real estate building up to the bubble, right? So for every percentage increase that the market increased by from 2005 to 2008, ESS appreciated by 1.23%. So it was more volatile during this period and more volatile in a generally positive direction because there was a bull market going on. So variance between residential betas and student housing might indicate that additional return was coming from speculation in the residential product market. So for example, here in the residential product market, we have betas of 1.2 and 1.4. Meanwhile, in student housing, we have betas that actually pretty much like either are directly tied or slightly under the market returns in themselves, which shows that these two different product types are unrelated in some sense, because both of the product types at the end of the day are putting beds for people to put their heads on at the end of the night, but at the very same time the markets, there is market diversification between these two, and they are being treated as two separate asset classes, and we'll get into some of the reasoning behind that. So here are potential reasons why I see this as being possible. So residential markets have many dumb money investors. Therefore, I would guess that asset pricing deviates from income-based valuation and moves to precedence-based valuation. And so in real estate, precedence-based pricing causes a ratchet effect as emotional buyers bid up property asymmetrically because they have features like granite countertops and stuff. So the idea with this is Vancouver's a hot market, so we're pricing based on precedence. Buddy down the street bought his place for $1 million, so this place down the street now has to be 1.01 million or something along the lines of that. At the end of the day, you're pricing real estate based on what's going on in the market rather than the actual incomes that are coming off the properties. And the reason why residential housing is more conducive to this is because you have a lot of dumb money or retail investors in the space who are not necessarily even valuing the things or the assets from an income producing perspective. They're valuing them from, I want to live here. I like the granite countertops as a emotional decision. And because of that, we deviate from a capital asset pricing model that's based on income, yield, and return. And the general residential market itself appreciates because, let's say 50% of the market is being bought by people who are going to actually own that home themselves, right? So even if the real estate investment trust is buying apartments which are rentals, which are then going to be based on a yield, it doesn't matter because the rest of the market, the rest of the residential market has individual retailer investors in it who are moving the market based on other reasons, such as speculation, such as buying for granite countertops, such as buying because Yale Town is a cool place to live, or is becoming trendy or something like that. And so because of that, even if the real estate investment trusts are acting as a smart money educated buyer in that space, there's still going to be capital asset price appreciation because of the externality effects of other people in that space. And so that is that's a core reason why I think that this is going on. The other thing is that yields. So now when we look at student housing, a lot of student housing is only owned by large large institutional investors, and those could be real estate investment trusts, universities, etc. As we saw in the kind of explanation of who these real estate investment trusts are, EDR and ACC have, like 70 some properties and 200 properties, and in those properties they have like in 206 properties, ACC has 132,000 beds. That is on average multiple hundred beds per building. There is not many retail and single investors who can afford to buy a multi-hundred bed building, and therefore this is one of the hypotheses that I have about being a student housing real estate investor, is that asset prices will actually stay much more sober over time because they will track yields much better. They will track income producing ability much better, because at the end of the day, institutional investors are much more likely to buy something based on a yield calculation than based on a speculation calculation, or have the market forces such as somebody buying their first home which they're going to live in and they're not going to collect rent on it, causing externality effects that cause the entire market to appreciate itself. So that's kind of potential reasoning from 2005 to 2008. The increased betas of residential right here, that potentially indicates that ESS and EQR in the residential space got overheated more significantly leading up to the housing crisis, which we'll potentially look at for evidence of it now doing a large correction afterwards. The slightly less significant betas of the student housing segment here says that maybe there is less speculation going on. Maybe it truly is a more soberly priced asset class, and therefore huge shocks within this asset class are less likely and will be less intense. And the other thing is that notice the difference in beta in R squared values as well. You can see that the pretty significant R squared values there for residential housing. And here is the aggregate numbers, right? Pretty significant residential R squared value there of 0.49, potentially indicating how these two asset classes really became linked to each other in the time period that led up to 2008. And because if they become linked, then we might also be wanting to look for them becoming linked again in the future as an indicator that says, these two things are starting to co-move stronger and stronger. Is there something going on? Obviously these became linked because of credit default swaps and other financial derivatives, which really added volume of of mortgage-backed financial products, added to the volume of them in public markets. So obviously it rationally makes sense that residential real estate itself became more linked to the overall market itself, because residential itself was becoming a larger player in equity markets in the overall market itself. Likewise, once again, there seems to be a weaker average statistical relationship here with student housing, but still more significant, I guess, than before, than what was witnessed one slide back or a couple slides back in before 2006, where there was just absolutely no statistical relationships between ESS and EQR. The reason why the residential or the student housing ones aren't analyzed here is because they actually didn't exist during that time period, which is unfortunate. So the next thing is that we can move on and look at what happened in the free fall period. And so, you can see the free fall period, all of a sudden, the residential players, let me change my color here. All of a sudden, these residential real estate investment trusts had got higher beta values, so they were actually amplified to the overall market collapse, which during a free fall period means that they would have sank in greater proportion than their S&P counterpart. And the statistical significance of the R-squared values were very significant here, showing that this was fundamentally a real estate related market collapse. And you can see on the residential side a beta of 1.5 and 1.2, really showing that, yes, the collapse of 2008 was fundamentally real estate linked, and there was exposure to real estate speculation, and that was a true driving factor during that time period. Then we can look at the entire fall and recovery period right here, and I'll change my color again. And once again, we can see that R-squared values are still significant, suggesting that even during the recovery period, asset repricing was going on as things sorted themselves up, suggesting that, even during the recovery period, real estate then also recovered with the market itself. It's not like real estate sank, collapsed, and then flatlined. The U-shape, trough and recovery also had real estate itself come back up during that trough. And that could have been seen in some of the earlier graphs and will also be seen a little bit later. And once again, the betas of the entire thing, of the entire, market in real estate, very strong. Potential reasoning behind this would be that once people actually learned and figured out and sorted that it fundamentally was a real estate related market collapse, there was lots of information being paid attention to. Investors were paying large attention to anything real estate related, and therefore, because it became salient in investors' minds, it also became more volatile in the periods that followed. And then what I think is extremely interesting is post this, all of a sudden, from 2010 to 2018, we moved to market betas that lag the S&P 500, which is what we would have seen, because a few slides ago we saw that since 2010 the real estate investment trusts have appreciated by around 500%, whereas the S&P 500 has appreciated by about 1,000% or 10 times, meaning that these beta values that lag market returns would make sense, right? Because every time the market's going up, real estate's going up as well, but slightly less so. But once again, I think the most interesting portion is the R-squared values drastically drop down. They are higher than from 1993 to 2004, but significantly, quite a bit lower than what was happening during these crisis years right here. Once again, kind of showing that, maybe there's been a correction, people aren't paying attention to it anymore, and real estate's moving back to a time where it is less related to actual market returns, and really behaves as a separate asset class. And so that concludes that, and now we'll just go ahead and look at, so this is from 2000. This is from the free fall period, right? So from 2008 to 2009, ESS, which is the residential REIT player who owns apartments, and this is our regression of the linkage of market returns versus ESS returns itself. And as you can see, during this time period, there is, a large clustering of kind of like, events like this, which shows that because this was the time period when things were collapsing, so there's a lot of negative return elements, and especially upon this visual inspection, you can see a whole pile of pretty significant clustering between ESS returns and what the linkage of predicted returns would have been during the collapse itself, and the linear. So here's our R squared value, 0.53. Pretty good model, accounts for quite a bit of the linkages in returns, and shows how the two really co-moved during the downward fall. And once again, now moving into the EDR, which is the educational company during that free fall period. Once again, more significant clustering here, closer to the regressions predicted returns based on S&P movements. And okay, so moving on. So that kind of, gets to some ideas about how equity markets reacted to the S&P 500, or equity markets reacted from a real estate perspective and from a general market perspective during that market collapse. But one of the things that's super important to consider is that a real estate investment trust, when you are trading units of that investment trust, that is a proxy for the underlying real estate below it. And so the underlying real estate below it doesn't move. This is where you get liquidity, is because the underlying real estate itself doesn't move, but then the units that hold that real estate are very movable and can also be bid up and bid down, completely disassociated from the underlying asset itself, right? When you're a private player and you have a pool of capital, the only way for you to get in and out of market is for you to sell that underlying asset itself. But when you move to a REIT model, you can get in and out of that asset simply by moving units which are proxies for holding that, which means there's also a very interesting externality, which we're going to explore here, is that the price to book ratios can vary a lot. So the next thing that we're going to look at is how price to book ratios fluctuated during the crisis. As we'll explore in later slides, most REITs are highly levered, and therefore their publicly traded market capitalizations should be compared to their equity positions in real estate they own themselves, logically making sense. Real estate is defined as a capitally constrained business. Income is strictly a function of capital deployed and invested. Well-managed teams can fight for percent returns here and there, as we said earlier, but when pricing productive assets that produce cash flow, the market prices based on a rate of return, a yield, or a cap rate is where market prices, generally tend to hover around. So therefore, when looking at these numbers, they're quite revealing. Firstly, the shocking thing is that residential REITs were traded at a price to book ratio of 3.5 and 2.3 before the collapse. So 3.5 here, price to book ratio, and 2.3 price to book ratio right here for our two residential REITs, EQR and ESS. Large REITs like this are required to revalue and state their asset values at the end of each fiscal year. That means even when the book value has been adjusted to actually reflect the market value of those assets based on precedents, right? Usually looking at what else is being priced in the market from recent transactions, you revalue your personal assets, which have not been through a transaction in that period, to reflect what has moved in that market. So even when adjusted for that, that means that the book value, investors were paying $3.50 for every $1 of equity that they would get put into a building, a residential property in the ESS REIT. So this is absurd and hard to justify, right? How many private investments do you know of where you would pay somebody $3.50 to own a building, a dollar in a building? So if you're buying a $1 million building cash, you would be paying that owner $3.5 million for his $1 million building. The accounting gets a little bit more complex than that of how this would work, but essentially that is what you're doing. And so small price to book premiums could be expected in a REIT to compensate for the efficiencies that a large institutional investor and management service would provide. So for example, buying these real estate investment trusts are super easy. You're not having to go out and contact lawyers, get home inspections done. You don't need to worry about tenants in them. Like, the REIT is taking care of that stuff. So it would be reasonable to expect that you'd pay a small price to book premium for these additional services that people are providing. But I'd say small. We're not talking multiplicities price to book. Further, holding the real estate through an exchange traded medium exponentially increases liquidity in the real estate investments, right? Like, I can enter and exit positions in these real estate investment trusts daily. That is not possible in private sector real estate investing. So therefore, this too would have to be compensated by a price to book premium. In my opinion, a premium of 3.5 would hardly ever be justified. And so this is going to skew kind of further analysis, because essentially things in this world of holding real estate through these mediums are irrationally priced, in my point of view. So in fact, like, notice the year-end numbers in 2008 for all of these companies. Boom, right here. They're all the minimum troughs, right? So notice that even at these points, residential property REITs only got down to an average of 1.75 price to book right here. Oh, that was bad, but you get it. Only ever got down to 1.75. So even at the base peak, when these things were trading at a base peak, trough, at the heat of the crisis, they did not. This is also skewing because they could have declined further in early 2009, but the problem is that we only have year-end numbers. But whatever, we'll continue with what we have. Even during this down crisis, the REITs were still so exuberantly priced that people were still paying $1.75 for every $1 in assets that they were buying. Once again, in my view, craziness. And as an investor, you could really say that the real estate market collapse was a great time to buy REITs because they were at the cheapest they've ever been. And as you can see, they've all upward trended since that point to now be trading back at their crazy price to book premiums. So on the student housing side, publicly traded equity is still extremely expensive in the pre-collapse and post-collapse periods. Like I said, once again, this indicates that at least from publicly traded entities, the student housing markets may have faced less speculation. I'd possibly attribute this to lower trading volumes. For example, in student housing, they're large buildings. Like I said, EDR or ACC, or one of them, owns 206 buildings. So therefore, every transaction that they have represents 0.5 of their portfolio from a building perspective, right? So because they're more concentrated in ownership of small concentration of many bed units, it would be possible that the REITs themselves. Okay, I've lost my train of thought. Because real estate in student housing, tends to be large transactions with many bed buildings, etc. We don't have, let's say like $5 million buildings or $3 million buildings, which private investors could realistically be getting into. We have $50 million buildings or $100 million buildings, which really means that it fully moves over into the, institutional smart money buyers, and also means that there's less trade volume, which means that, from 2008 to 2009, these student housing managers could have possibly just experienced a blip period where a blip period where there was an unusual amount or unusual lack of trading volume of buildings, but because trade volumes are so low already, it wasn't massively different. Anyways, this might also explain why the price to book is lower generally, right? Like, EDR was inarguably a fantastic buy right here at 50 cents on the dollar price to book, and even ACC got to a reasonable buying price of $1 for $1 in assets. So once again, because these markets might be more dominatedly based on income-based valuation rather than precedent transaction-based valuation, they might stay at more sober ranges. Something that I think has been part of my strategy in my real estate investment business, and something that I hold true of, knowing that I'm not getting into bad positions, because I know at the end of the day the income on the places backs up the property value, and I'm not paying speculative premiums, I guess. So, overall, this chart could potentially demonstrate faith in real estate markets, as an investor would not rationally increase the premium they pay for $1 worth of real estate in an asset class that they're not confident in. So what I really mean by this is, this trough right here and price to book could potentially be a good indicator of where market faith is at the moment. So for example, here, real estate, to demand this peak of price to book ratios for the equity invested in these buildings, the market has to be quite bullish on that, right? They're saying real estate's going to the moon, etc. I'm willing to pay $3.50 for every dollar of equity in the building. Like, it makes no sense, right? So market faith is strong. All of a sudden, this could be an indicator for market strength has weakened significantly. investors are now demanding more realistic prices to get into these real estate investment trusts, which could be a proxy for overall real estate market sentiment, right? We have a real estate centric collapse going on. Market sentiment has decreased in that. Likewise, coming out of it would then indicate that market sentiment has recovered in this period as all of these price to book ratios continually increase and have stabilized, although these ones are more realistic over here, have stabilized up at more high values, indicating that potentially hype around the market has really cooled off, which would be a good thing. So one of the key takeaways here for me is that even in a recession that was fundamentally real estate driven, the time span that you have to consider about wintering through is, about, let's say, is about, somewhere between 3 and 5 years. Right? So in this time period, we had everyone's happy with real estate, everyone's a super bull or a super bear on real estate, all the way to market sentiment recovering in that time period. And that's a super important conclusion because that suggests that we should be aiming to weather any 3 to 5 year storm at any given time. And if you're able to weather a 3 to 5 year storm, that might be a conservative enough position to make sure that you don't get into a distressed situation ever. Now, we'd have to get into and talk about how do you actually weather a 3 to 5 year bear market in real estate, but and what the stressors would be, such as debt renegotiations that come due, that would be a stressor. Cash flow requirements, that would be a stressor. Decreased top line income because of higher vacancy rates, that would be a stressor. So when modeling this stuff, you'd have to indicate how much stress you could potentially be taking. But the second extremely important aspect here is how long do I need to bear that stress for? So this is actually a key conclusion of, in 2008, it took, depends on what you say, but 3 years, I guess, actually, no, 2 years on the optimistic side, 5 years on the pessimistic side was the true time that it took for the market to rebound on public dollar investment sentiment. And then, of course, that's going to be important because that's going to guide our ability to get financing, to renegotiate financing on places, to get banks to support us with debt instruments, right? This is a good indicator for what type of timelines we're working with of how much stress do we need to undertake. And then down below I have price versus book for each product segment. And once again, that's quite important because it gives us an indication that yes, student housing does seem to be more reasonably priced from a price to book, although it's still high, than residential, which is congruent with my investment thesis, I guess, that residential or student housing is a safer investment class because it's more soberly priced through income-based approaches, and it is and it has less vacancy risk. So, the less vacancy, or it's less speculative. There we go. There isn't market pressures that would be raising where dumb money retail investors would be raising prices based on more emotionally driven factors which could potentially get things to be looking quite bubblicious. So in this next slide here, we have the debt price to book ratio for all of the different REITs over time. And really, I wanted to look at this because I wanted to see if there was some accounting error or something fundamentally wrong that I was, doing with my analysis to see that price to book on equity was so, had such a high ratio. And so from looking at this, we can see that price to book on debt is rationally priced and even, considerably discounted in comparison to the 1-to-1 ratio that would be par value. And this is because this could be because movements in interest rates, discounts based on default risk assessments, etc. The interesting point of the graph, though, is that it proves that the publicly traded equity in these REITs is trading at irrational premiums, and more that it's not an error of some type of accounting, accounting misanalysis on my end. So that is, that's one piece to confirm that the equity truly is mispriced. And so the next logical item to examine is what exactly happened to the balance sheets of these companies during the crisis. Firstly, because real estate is a highly levered business, I wanted to look at what happened to debt levels during the crisis. The graph dollar donates or expresses the dollar amounts of debt held by each of the firms, but the graph itself, once again, because EQR just happens to be a larger firm, is skewing the information based on the access. So instead, this next graph is a much better indicator where I've normalized things into year-over-year growth. And so 2008 was largely a liquidity freeze, which can be the worst nightmare for real estate firms. And that is something, coming into this, that, rhetoric around the recession itself was largely focused on the fact that it was a liquidity freeze, and we did have financial markets tighten up and get highly conservative for a brief period of time, as kind of liquidity in the markets was questioned and people weren't willing to, freely allow things to flow. And so, like I said, in 2008 was largely a liquidity freeze, and this can be a nightmare for real estate companies. So, for example, if you had a large amount of debt due in 2008, if you were not able to personally cover your debt positions with equity, you might be forced to sell assets at a distressed value in order to cover your positions in other failing assets and debt that has come due and must be refinanced. The problem is in a liquidity freeze, you might not be able to refinance this, and this is where some of your bankruptcy and insolvency risk comes into play. Therefore, one strategy would be to ensure that one could meet your debt obligations via internal financing for a 1 to 3 year period, given the worst case scenario that, let's say, a liquidity freeze where we couldn't refinance anything, not even just at favorable, because this isn't also talking about not being able to finance. In a liquidity freeze, sometimes you're not able to refinance at even very expensive rates just because everyone's hurting and there just isn't the ability in the market to do that. And so, the idea would be that even, assume that we can't get any refinancing on our debt instruments, which are used to lever our real estate portfolio. Can you, as a strategy for a firm, potentially ensure that you have internal financing requirements, be it through, diversified cash or highly liquid portfolios in other securities, such as equities, bonds, money market securities, etc., which would then allow you to safe haven your real estate assets without necessarily losing out on inflation for that cash that you must hold in order to meet internal financing requirements. Then after the liquidity freeze, when financial markets pick up again, then you can obviously relever. But so the interesting thing here is that, kind of based on some of those hypotheses that I just made there about the financing freeze, you can see the effects of this occurring during the recession. So through the middle of 2008, ACC, which is here depicted in dark blue, the recession started about here. Now, one of the problems is that this is end of year financial statements, right? So this smooth line curve is really not representative of how things would have played out, because changes in financing is also timed to transaction deals. So this notion that it's highly contingent on many factors. It would be like debt is coming due, which needs to be refinanced. Anyways, so we're going to assume that liquidity and the ability to get financing to relever the portfolio really dried up when the recession, when the market started to collapse in late 2008. And so what we can see is that kind of, in the same idea, 2009 for all of these real estate firms across the board was just completely unable to get new financing. And in fact, a whole bunch of these, all of them, in fact, are below this 0% growth line, which means that their debt positions as a percentage of their entire assets did decline, suggesting that their companies slightly delevered in the financial crisis, which would mean that their equity positions increased. And so for large real estate investment trusts like this, they have access to more complex financial instruments, right? So we're not just talking about regular mortgages. When you have a large portfolio which is collateralized against itself, we can be going to banks to be getting more complex financial instruments, which more work as lines of credit rather than actually putting principal back in, because we want to have the portfolio levered at the same ratio roughly throughout its entire career. And that's usually the strategy that a lot of REITs take. Now, what you do then is you have, staged debt instruments that are maturing at each year. For adjusting duration, interest rate exposure, and also cash requirements that are required in any given year. And so this is exactly what happened. And all of these firms were able to manage this because of the internal strength of their companies. So all of them actually, based on this graph as trying to be a proxy indicator that they weren't able to. So this is my assumption. We had all of these firms during 2009. They had debt instruments that were coming due. Under normal circumstances, they'd be rolling over that debt. The problem is during the liquidity freeze, markets weren't willing to refinance these portions that these companies had that were coming due. So what do you do in that position? Well, you need a way to secure. You need a way to pay back, right, that former debt instrument. So how can you pay back that former debt instrument so you don't default on the balloon payment that you have coming due? Well, if you're cash healthy and you're healthy in other liquid investments, you can liquidate those, use those to pay down that debt, right? And then that would increase the equity position in the entire company, which is what's observed in all four of these REITs. The second idea, well, I guess I had something else, but now I forget that. But the key takeaway here is that even for these big REITs, because that's the other thing that we got to consider, when you're a large institutional investor like this, you are able to get direct access to, pension, to do private lending, to get access to pension funds, get access to commercial banks and stuff. People who are actually, willing to take on, let's say, $100 million loan, which means that as a private investor, you do not have those same opportunities, and you're way lower down on the pecking order of who liquidity is going to be restored to upon the market turning around. Which means that, for a small private player, this effect to be able to have cash reserves that allow you to meet upcoming debt financing costs through both balloon payments and interest rate payments on let's say conventional mortgages and stuff is very key, because under a worst case scenario, which we actually do see here, where let's say vacancy spikes. So at the same time we have vacancy spiking, which means that top line revenue is going to come in lower, which means that operating margins are going to become lower. Meanwhile, our interest, our debt payments, and everything stays fixed, right? Based on the dollar amounts that we've raised. So all of a sudden we have fewer dollars coming in and the same amount of dollars that need to be going out. And if we have our debt structure poorly structured, we could also be very unlucky where we just had, let's say, 20% of the entire company's debt coming due in that year. And this is the whole thing that you want to avoid, because you want to have, and this is a firm strategy, which all of these REITs are strong enough to exhibit in 2009, is that they were able to internally finance increases in their equity positions by means of paying off the occurring debt, which they couldn't get refinanced, and to weather that storm. If they weren't able to do that, they might have had to sell their assets that they were holding for to cover the balances, which is a horrible place to be in, right? Because not only are you potentially defaulting on asset A because you can't make the balloon payment that's due on asset A, but also we might have to sell asset B and asset C at distressed prices in order to pay off asset A. So at the end of the day, what we've actually lost is we've just sold asset A and asset B. When we bought it at 100%, we're now selling it for 50% of what we bought it at, just to cover one other building. And this is where we destroy our capital base. And so very interesting that all four of these firms in a recession that was directly targeted and aimed at real estate in general, they were healthy enough to internally finance their debt requirements that had come due in that year in order to weather the storm. And then we can clearly see it's interesting because they all the co-movements in ability to finance here are quite related just by visual inspection, right? So here we can see that essentially all four of these firms had their debt growth go negative in 2009, right in the heat of the crisis. Then in 2010, all four of them, were able to modestly increase their debt positions. Now, at the same time, this isn't necessarily the leverage ratio that's changing, but they're increasing their debt as a dollar percentage, as a dollar amount, because they're increasing their entire asset base. But it's interesting because this suggests that this is a relevering. So this is increasing their leverage ratios. Let's just say debt to asset ratio, and based on other analysis that I've done, is that later on, here, then they start expanding their balance sheets again. So they start buying assets here. And here, expanding their asset bases again. And obviously here with, ACC in 2012, increasing their dollar denominated debt by 50%. That's a big increase. So obviously, if you're able to raise that much money in debt markets, kind of full liquidity and full ability to finance has been restored. And so, I guess the big conclusion here is that, if there's a financial crisis like this, these firms who, keep in mind, they will have the best access to debt financing of anyone on earth, because institutional investors carry a lot of clout and professionalism, whatever, to them. They really had to, let's say, suffer a liquidity freeze that we know and started in late 2008 and really carried probably into 2010. So we're really looking at a 2 to 3 year period where if you were confident that you could meet internally all of your debt requirements for 2 to 3 years, you could be quite confident that you would have made it through 2008 quite happily, I guess. And so now this kind of brings us to the idea of would this strategy stack up in the future? And of course, you never know. You could enter into depressions, right? Where you're in a long run finance and leveraging cycle where the entire economy starts deleveraging significantly. And then who knows? Maybe that 2 to 3 year time span wouldn't be sufficient enough for you to be able to now start to roll over and figure out how to renegotiate and relever your debt portfolio without having to take drastic actions like selling off assets at discount rates, because that's the fundamental thing you want to avoid. So the next one is market capitalization versus time. So here we can look at what happened to the publicly traded equity in REITs. Now remember, real estate is a balance sheet company, and therefore this represents the publicly traded equity and not the tangible equity tied up in buildings. Once again, this graph distorts information because the market cap of EQR is so dominant, but we are able to see that from the peak to the trough, EQR sank almost 50% here. So, from here to here, it's almost a 50% sinking. And so remember from earlier as well, from earlier slides, that price to book of EQR never got down to even 1.5. So this means that although the traded equity sank by 50%. So we had a 50% reduction in the traded equity value or market capitalization. The price to book of the underlying assets still only got to being 1.5, which means that the tangible equity value of the or the book value of the equity in the company is actually kind of down here somewhere. I can't do the quick math, but which is kind of funny because it shows that these publicly traded vehicles that even during 2008 never even got to what I would call reasonable purchasing price. So although it sank by 50%, it really shows how hot and how high priced the assets were at that time period. Yes. Now, unfortunately, as a private real estate investor, you don't really get to take advantage of getting people to give you money for $3.50 for every asset, for every dollar that you're going to put into a building. That's really awesome. It's good for management, good for insiders, bad for the people putting it in. But and so the next thing, once again, now we're going to look at market capitalization year over year growth to normalize all this information. And so here it's more clear to see the contractionary period in market sentiment really lasted only 2 years, right? So once again, here, this is the contractionary period, and then things move to all green and happy kind of from 2009 onwards on the whole, market capitalization view and point of things. And so so during this 2-year contractionary period, market sentiment definitely went down the tube, and this means that a firm would move into high insolvency and bankruptcy risk as the liquidity needed to refinance expiring debt, pay for development costs, and inject equity into projects would be hard to raise, right? So this is the other thing, is that you're unlikely to be able to raise money to cover your positions during the crisis as well, just because everyone's in a psychologically, bad state where they don't want to be investing. Unless you are smart and able to tell people that things are well priced right now, because they would be. And once again, kind of like the good news is that what this can be viewed as a proxy for how long market sentiment around real estate got depressed for, and it looks again like that 2-year period would be a nice conservative bet about how long one would have to expect for the market to stay kind of in a really bearish state. And so now we're going to move into comparing enterprise value, so the publicly traded or liquid version of the company, in comparison to the underlying book value of the assets. And this is an extremely relevant, like I said before, this is an extremely relevant measure because real estate is a capitally constrained business. It's a balance sheet business. Profitability is calculated based on balance sheet assets and utilization of those assets. And it's not like we have a heavy labor or people intensive business, and therefore like balance sheet analysis and profitability based on the balance sheet is really king in this scenario. So unfortunately, I was not able to pull data on this that went further back in time. Further, the problem with the book value of assets here is that it includes both capital appreciation in existing assets and newly acquired assets. And it's only reported on the ends of the financial year, right? So therefore, you could not conclude here that in 2004, ACC had $500 million of assets, and here it grew to $7 billion in assets. That's not a right conclusion, right? Because we have new properties being acquired. We have capital raises that are going on, right? So between 2011 and 2012, this was obviously a large capital raise that went on, and then that money was then invested in properties, which would also make sense because you have by enterprise value separating in this region where enterprise value gets steeper and separates away from book value. This would also be because they haven't deployed the capital yet. But yeah, anyways, once again, I'm interested in these graphs because I want to know how long the winter was, how long was the bad sentiment winter, and so here in this graph you can see that this student housing REIT was priced at a small premium in the pre-crisis period. So from about 2004 here all the way up to like the crisis, starting there. The publicly traded vehicle is trading at a premium to the underlying book value of the assets, and then as expected, when the share prices tanked during 2008, all of a sudden for the first time we actually have the book value of assets slightly exceeding the publicly traded value of the enterprise, I guess, as people start to worry about insolvency risk, etc. But then, really I find moving from this point on, from 2009, all the way through 2017 here, this really telling that these book to enterprise value ratio or spread, just fully comes back and is even, trending to be wider lately, saying that I'm less interested in this because I want to view things about how things are priced from the perspective of me, myself, a private real estate investor, and so I don't get the advantage of raising money at massive premiums to the actual underlying book value of assets. But I guess this could be once again an indicator of market sentiment, bullishness, etc. So moving on then, here we have EDR, which is the other educational REIT that we're looking at. And interestingly enough, EDR, the book value versus the enterprise value actually teetered back and forth in the pre-recessionary period. And once again, as we're going to see in a second, this is much more sober in comparison to the residential markets. And once again, this is, a further evidence which confirms that student housing potentially is constantly more soberly priced, I guess, in comparison relative to regular apartment housing. Right? Because as we'll see in a second, residential housing in the 2007 to 2004 period was kind of like equally exuberantly overpriced in public markets, in my opinion. But then, so here we go. Enterprise value dips below. This is like good buy range, right? Because now we're buying, $1 of assets for 80 cents. And then once again, we see a very similar trend where slowly over time, the price to book ratio of enterprise value to book value of assets has continually ratcheted back up, which does suggest that things are, at least on the publicly traded side, overpriced. And from a private investor perspective, I'm going to be able to, as a private investor, I get to buy everything at its book value, right? Because I go out and I actually buy the thing itself. I'm not paying for the liquidity premiums that you pay for as an investor who's buying on the publicly traded line, which means that the price to book ratio doesn't really matter for my business all that much, because I'm going to be able to go out into the market and buy things at real prices. The thing that this could turn into and be an indicator to watch is, how hot is the market getting? Because bubbles form when the your shoe shiner is telling you what are the hot stocks to buy, right? So, and not to be like derogatory or something, but when the dumb money starts to get very excited about something, you know that this might have run its course, right? And so based on this analysis, I almost see that, watching price to book ratios of these publicly traded real estate investment trusts could be an indicator to watch for market exuberance around real estate. And why I say that is because you must be very excited about something in order to pay premiums of book values for a balance sheet based company, right? And so, not saying that it would necessarily predict anything, or there'd be any ratio amount that would actually trigger something to happen, but could be something good to watch. And one could adjust your strategy by saying that, price to book ratios on publicly traded real estate are, extremely high right now. Makes me worried about, widely hitting bubbles, as there's just too much bullishness out there. And so I'm going to hold my positions in the buildings themselves, but I'm going to increase my cash and my reserve funds, which would guarantee me that I could make it through the next the next bear run. And who knows, maybe even have cash on hand to be buying buildings when they're at those discount rates, and take advantage of everyone who got too carried away with things. And by cash on hand, I mean just, more liquid, other diversified holdings. So, you could be in world, global market equities, things to beat inflation, right? Because the reverse of this is you get too conservative, and you get too conservative, and then you're losing out on returns because you're holding this whole cash hoard, which will allow you to internally finance through a liquidity and a financing freeze. So the next couple, I'll just go through these quickly because I've kind of explained my ideas behind book value versus enterprise value and the price to book ratios. But once again, here we have EQR, which is the residential real estate investment trust, not the student housing one. And we can see that, congruent with my earlier hypotheses, these residential REITs are pretty much always staying at a crazy premium, which shows that even residential, in comparison to student housing, potentially has way more speculation going on, from many investors in the market, and some of those effects are through personal people buying homes, etc. Some of the items that I talked about earlier. And once again, here's ESS, our other residential real estate investment trust. And likewise, unlike student housing, there always is a premium between, the enterprise value of assets and book value of assets. And once again, you can see in 2013 that the company was healthy enough to do a massive capital raise between 2013 and 2014, year, which really effectively grew their company by over 2 times in size. Once again, an indicator of can't do large capital raises when the sky is falling. And here we go. Here are the compiled averages, where we can see that of student housing book value versus student housing enterprise value. And once again, you can see that after the crash, things start to get wide again, which is very interesting, right? Because if we have a large speculative bubble before the crash right here, book value and enterprise value pretty much tracked. Publicly traded enterprise value pretty much tracked each other pretty perfectly before the bubble, right? And this is where the bubble's going on. So this is confusing, right? These premiums being paid here, that is confusing, and probably deserves even much more analysis to figure out why, since the bubble, which was a real estate bubble, did people start willing to become to be paying for massive premiums in these real estate assets. And once again, here we go. Here's the residential enterprise value versus book value. And in this space, there is always this premium, which kind of fluctuates over time. But we can see that the premium itself is higher at the moment here. So then the last portion is kind of doing a little bit of yield analysis and how the cash flow producing abilities of these companies were changed by the economic shock. And so, in the world of real estate, operating income is the amount of cash you take home after accounting for the maintenance, the management fees, that are associated with a building. Net operating income is usually used to set a yield or cap rate in real estate jargon, standing for capitalization rate, to determine the capital asset price of a specific building. And this works at a building level to price specific buildings, but the problem is when you become a syndicated real estate portfolio, which is collateralized against itself, net operating income is no longer appropriate. And the reason for this is because the accounting gets very complicated through gains on sales of assets, if other purchases occur, and properly matching up the income directly on a per building to building ratio relative to the asset itself that's generating that, and then disposing of it becomes very confusing to get all of the timing correctly. So therefore, real estate investment trusts use a term which is funds from operations, which tries to help correct for this. And so what funds from operations is net income, add back depreciation because that's a non-cash expense, add back amortization because that's a non-cash expense, and then subtract off gains on sales of property, because we don't want one-time cash windfalls to be influencing, I guess, what is the actual operating income of the building. And operating income being defined as the cash income that's directly coming from the assets we hold themselves and not the sale of those assets. So then the next thing is then we get to AFFO, which is adjusted funds from operations. And this just adjusts further for other things that could really be skewing the ongoing income ability of the company. So we subtract out capital expenditures and a few other adjustments that are deemed to be reasonable, with the idea of getting a good sense of what the cash flow off the buildings are, which is likely to be very sustainable into the future, and doesn't include capital expense or isn't like the reason why we subtract out capital expenditures is because those are material upgrades which need to be made to the buildings in order to maintain their cash flow producing abilities. So if we didn't account for capital expenditures, essentially the grades or the income producing abilities of our assets would be degraded over time as the buildings age and the buildings weather. So what we want to do is adjusted funds from operations essentially says, here's all the cash that a building earns, given the assumption that we've done our work enough that this cash flow ability will not decrease in the future because we have the proper reinvestment levels and we've taken the proper management steps to maintain these assets moving into the future. And so now we can kind of create a pseudo capitalization rate for these entire real estate investment trusts by using the adjusted funds from operations over the total assets in order to get an effective, yield or capitalization rate on these portfolios of assets. So this provides an interesting analysis. EDR in 2005 is an outlier. I'll handle that quickly. That is just simply because of accounting standards and really should just be ignored as an outlier point. That it randomly hit 0 in 2005. They were changing their accounting practices. So this graph shows AFFO divided by total assets. Assets are calculated on a year-end number and not averaged over the period. I've chosen to do this because either way, the analysis is inaccurate as to the asset levels. As I explained earlier, the buildings and property, its real estate itself is acquired on an ongoing basis. And unless we had day-to-day rent streams that were perfectly matched against the assets itself, we couldn't get any type of very accurate pinpoint funds from operation, like capitalization rate of the direct income producing ability attached to the direct asset that it corresponds with. And further, unlike private real estate firms, public entities are required to revalue their assets every year. Therefore, this ratio is actually telling you more than what a private firm could about their ongoing capitalization rates, because both the income and the asset prices are properly adjusted to market rates at the end of each period. Obviously, the adjustment is non-cash in accounting valuation, so the holding period return of the asset actually doesn't materially change because the holding period returns based on the price level that you buy the asset in, and not, you'd be taking a write down, right? If the net income stayed the same, but the asset itself decreased in value. It's not like your yield, where your numerator stays the same and your denominator shrinks. It's not like you just get a windfall on yield for that. But what this does is it kind of does a good job of doing a ongoing year-to-year market valuation of the yield, the realistic market yield of, if you sold the entire portfolio, what type of return on investment would investors be looking to buy that. So firstly, we can see that yields on student housing in blue are lower than that of regular residential housing. This is congruent with the idea that student housing is lower risk than residential. University enrollment levels are stable throughout all periods, especially those that are oversubscribed to for enrollment. So through the perspective of Queen's, business school, for what I mean is, Queen's Commerce turns away 9 people for every one that they accept. Therefore, placing a judgment that this asset class of residential housing has very low vacancy risk is probably a pretty good assumption, because even during recessions, Queens has 9 people who are trying to get into the program for everyone that gets in, or 10 people for everyone that gets in, right? So the demand levels for these campus housing is likely to stay at 100%, occupancy at all times. So secondly, we can see that yields fell during the collapse actually. So from, 2008 here to 2009, pretty much across the board, we have slight collapse in yields leading up to it. Now this one's a little bit harder to kind of determine what's going on, because downward pressure on yields, right? So let's look at this from the perspective of ACC leading up to the crash. So this downward pressure on yield through this period makes sense as capital asset prices are getting overheated and income isn't keeping up at the same rates. And this is actually, a good depressed yields usually means that capital asset prices are, it always will mean that capital asset prices are rising relative to the income, right? Because that's how yield calculations work. But interestingly, usually yield or income producing ability cannot raise at the same rate that capital asset prices can raise. And the reason for this is usually rent controls and also leasing time horizons mean that there are restrictions and regulations based on the amount that yield can increase in a period. So, for example, in the Vancouver market right now, the new tax law, which is taxing foreign investors for buying residential real estate. Now, what's being seen is that yields on commercial real estate in Vancouver have gone very low because commercial leases are normally, let's say, 5-year leases where we're locked in at a certain income level, but when we're locked in at that lease, the building itself can freely trade, right? So it can trade and change ownerships. So across the board in Vancouver, commercial real estate yields have gone to zero because the capital asset prices, all of the foreign money, instead of flowing into residential real estate, it's now flowing into commercial, bidding up the price of commercial real estate, and therefore the income's locked in for the next 5 years, but the denominator in the function, the capital asset price, has shot through the roof. And so this is why normally capital asset price can be more volatile relative to what income producing abilities can be. And it usually works the same in rental markets for residential housing, right? Because a lot of jurisdictions have maximum rent increases, which are usually just set to inflation for existing tenants, etc. And so yield becoming depressed can be because the capital asset prices in the market, which are not governed by law, can quickly shoot up, whereas the income producing ability on those assets can't keep up at the same rate. And so this period right here, where we have ACC having depressed yield coming into 2008, makes sense as a whole pile of their assets aren't able to keep up with the capital asset speculation and price increases, but they can't get rents up at the same time to get that yield to stay consistent. Likewise, from 2008 to 2009, we see yield shoot up at ACC and these other brands, although it is noted that ESS is an outlier and actually decreases over that period. But once again, this makes sense where during the period because during the period, because the asset prices are collapsing because the bubble's popping, the incomes are still relatively strong enough that, or haven't faced the same downward pressure as the capital asset prices have. So, in the equation where we have income over the asset prices, the income has stayed neutral, but the asset price itself has decreased, and therefore, as a function, this entire function, goes up, which means that, as expected, during bubble price collapses, these start to be better times to buy, because if you're an income holder, these are all depressed yields. You care about yield. So here we have yield increasing, and you can actually see that yields increased all throughout here. And that is likely due to trailing effects, where now rents are starting to pick up and increase, because rents, because of regulation, tend to just increase very, very steadily, because you don't have the option to have large market fluctuations. The most interesting thing of this entire graph, though, is that even during the height of the crash, none of these asset classes, for reasons that I stated earlier, such as, at the end of the day, your home is the last thing that goes, your business goes out of business, but vacancy rates still didn't fall all that significantly in a whole pile of the assets that these REITs were holding. So therefore, the income producing ability stayed relatively strong, which actually means that these businesses were able to rely on having, even if it was just slightly depressed operating income, they were able to have relatively strong operating income in comparison to what was happening to the underlying shock to asset prices. So as long as you're able to ride out that period, you could emerge on the other side where asset prices recovered. And so once again, very core conclusion is that you want to have a good ability to ride out, stresses or market shocks, to avoid, having that capital asset base destroyed, where you have, via selling at discounted rates and things like that. And so this is good news, though, because it means that the last thing that you need is capital asset prices destroyed, debt repayments, and balloon payments coming due, and having no income on your assets themselves at the same time. So this kind of proves that, these businesses had their capital asset prices hurt, which can do things to market sentiment, but doesn't really necessarily materially affect your buildings themselves. Secondly, they had debt repayments which came due, which is a cash constraint for the business. And lastly, though, they did not have their cap rates or their operating income materially hurt, which is a huge bonus, because that operating income is massive in order to sustain your business from funds directly from the operation to continue to take to inject equity into buildings that need them, and you're not forced to now go borrow money from exterior forces. So this is a really nice conclusion that really it was not horrible. The income producing ability of real estate during the crisis was not horrible and recovered pretty quickly after. So this is last one, which is kind of on leverage, I guess. And we talked about this at length, but as you can see, that this is equity over assets. As I like to demonstrate and look at leverage like this because it makes sense, because this is like your pseudo down payment requirements as a percentage of the asset price in real estate. And so you can see that from 2008 to 2009, there was actually, as a percentage of total asset base, equity was injected, and equity positions in these companies were increased. This spike represents a capital raise by a company who then didn't deploy it yet and didn't get financing to deleverage their positions in buildings. So that's why that outlier exists. But one of the key conclusions is these firms do look more risk adverse from their percentage of leverage that they use in their portfolios in the post-crisis area in comparison to the pre-crisis, right? A lot of these numbers, now clustering around 50% levered, and here before maybe 60 to 70% levered. So overall, I guess these companies have reassessed their debt ratios post collapse, and maybe are taking something now a little bit more conservative, because 2008 2009 was very concerning, although they were all able to weather the storm. So what are some broad conclusions from this? So as observed through this proxy of looking through the eyes of these firms from 2008 to 2009, the asset price collapse really happened for 2 years on the optimistic side of things, and 5 years on the very conservative side of things. And this is a key takeaway, because this is a great thing to stress test for in your organization, I guess, is if the market went into an absolute liquidity freeze and you weren't able to get financing to refinance your upcoming debt, and you weren't able to get financing or external equity funding for development projects, etc., could you survive a 2 to 5 year period without having to sell off assets? The next thing is that the income producing ability was not devastated across the two product segments. So another key takeaway, which is great news for people in the property management and long-term investment viewpoint, is that actually if you are able to ride out the storm, essentially during the storm, the income producing ability doesn't fall to zero, let's say, which makes sense because people are still going to be living in a home during the collapse. It's not just like people start camping is a last resort. That's the point. Next, real estate was highly unrelated to market performance from 1994 to 2006, highly related to the market in 2006 to 2010, and now has moved back to being relatively unrelated from 2010 to present. What this means could be a lot of things, potentially if there was stronger correlations to the stronger beta values of real estate relative to the S&P, again, that could be a potential indicator that things might be getting overheated once again. But that's generally interesting from a point of view that really proves that 2006 to 2010 was a very real estate centric market collapse, as the S&P and the general market really did co-move with the real estate market significantly. And now we're looking that there could be many corrections coming to equities markets here in 2018, and the fact that market performance has been uncorrelated to S&P performance from 2010 to present suggests that relative to the hotness of the current equity markets, real estate might be reasonably not as hot as it has lagged in performance for the last 8 years. The next thing is, lots of evidence throughout here that student housing is less volatile in relation to the equities market and also the apartment residential market for those reasons that were discussed throughout. Another broad conclusion is that REITs trade at an extreme price to book premium, with residential housing appearing not residential housing, with student housing appearing to be more soberly priced, trading at less crazy premiums. And once again, I think that this is because it's bought by smart money, large scale transactions, professional buyers, stays away from forces that would otherwise get the market into extreme speculation and bubbles. Student housing yields are depressed in relation to residential housing, as rationally predicted, once again. And then there is evidence to support that one can expect a financing liquidity winter of 2 to 3 years. And so when doing stress testing and thinking about strategy for real estate portfolio, I think that this is a key takeaway of, if a liquidity freeze and a financing freeze happened tomorrow and lasted 3 years, would we be able to make it through that point? Because that would have been a test that would have been valuable for 2008. And during this fundamentally real estate related collapse, the winter only lasted 3 years at most. So now, of course, there could be a depressionary scale collapse, and it'd be interesting to see if we had better market data about what a depression and a large market-wide deleveraging would look like and take to survive through, without having to, what type of internal financing capabilities would you need to be able to self-support your portfolio during a massive deleveraging like the Great Depression. Fortunately, we don't have very much information on that, but here, fundamentally, 3 years was a good time span. So, thank you for listening, and I hope you learned a lot.